Most people think investing is about making money, finding the next big stock, catching the perfect opportunity, doubling your capital as fast as possible. But the truth is, that's not what separates successful investors from everyone else. The real difference is this. Successful investors know how to protect their money, because in investing, one big loss can erase months or even years of progress. And that's exactly why risk management is the most important skill you can learn. In this video, you'll understand what risk management really is, why most people ignore it, and how you can start protecting your capital like a professional investor. Let's start with the basics. Risk management is not about avoiding risk. That's impossible. Every investment has risk. Stocks go down, markets crash, even safe assets can lose value. Risk management is about controlling how much you can lose. Think of it like this. If you lose 50% of your portfolio, you need 100% gain just to break even. That's why avoiding big losses is more important than chasing big gains. A simple rule to remember: survive first, grow second. So why do most investors fail at this? Because they focus only on the upside. They ask, how much can I make? But they never ask, how much can I lose? This leads to common mistakes. Many beginners go all in on one stock or one asset. Some follow hype, trending stocks, viral crypto coins, hot opportunities. Others ignore risk completely and just hope the price goes up. And when the market drops, because it always does, they panic. They sell at a loss. They lose confidence. Some quit investing completely. Not because investing doesn't work, but because they didn't manage risk. Now let's talk about how to actually do it right. There are a few core principles that every investor should follow. The first one is diversification. This simply means don't put all your money in one place. Instead of betting everything on a single stock, you spread your investments across different assets. For example, stocks, ETFs, maybe bonds, maybe a small portion in alternative assets. Why does this matter? Because not everything moves the same way at the same time. If one investment goes down, others may stay stable or even go up. Diversification doesn't eliminate risk, but it reduces the chance of a catastrophic loss. The second principle is position sizing. This is about how much money you put into a single investment. Even if you believe strongly in something, you should never risk too much on it. A common approach is to limit each position to around 5 to 10% of your portfolio. That way, even if one investment performs badly, it won't destroy your entire portfolio. Think of it as controlling damage before it happens. The third principle is understanding risk versus reward. Before you invest, you should always ask, is this worth the risk? If you are risking $100, what is the potential return? If the best-case scenario is making $50, but the downside is losing $100, that's not a good trade. But if you risk $100 to potentially make $300, that starts to make more sense. Good investors don't just look for opportunities, they look for asymmetric opportunities, where the upside is significantly larger than the downside. The fourth principle is having an exit plan. Most people only think about when to buy, but smart investors think about when to sell before they even enter a position. Ask yourself, at what point will I accept that I'm wrong? This is often called a stop-loss level. It's not about being perfect, it's about being disciplined, because without a plan, emotions take over, and emotional decisions are usually expensive. The fifth principle is long-term thinking. Markets are predictable in the short term. Prices go up and down constantly. News, events, fear, hype, all of it creates noise. But over the long term, strong investments tend to grow. If you zoom out, volatility becomes less dangerous. This doesn't mean there is no risk. It means that time can reduce risk if your strategy is solid. Let's look at a simple example. Imagine two investors. The first investor puts all their money into one stock. They believe it will go up quickly. But the market drops, the stock falls 50%. Half of their capital is gone. Now they need a 100% return just to break even. The other investor builds a diversified portfolio, some stocks, some ETFs, maybe some safer assets, and some cash for flexibility. The same market drop happens, but instead of losing 50%, they maybe lose 10 or 15%. That's a big difference because the second investor is still in the game. They can recover, they can continue investing, they can benefit when the market improves. This is what risk management really does. It doesn't make you rich overnight. It keeps you alive long enough to become rich. So what does a simple risk management strategy look like? You don't need anything complicated. For example, a balanced approach could look like this: a large portion in diversified ETFs for stability, a smaller portion in individual stocks for growth, some allocation to lower risk assets, and some cash for flexibility. You review your portfolio every few months. You adjust if needed. You stay consistent. No extreme bets, no emotional decisions, just a system. At the end of the day, investing is not about being right all the time. Even the best investors are wrong sometimes. The difference is they don't let one mistake destroy them. They control risk, they limit losses, and they stay in the game. Because the longer you stay in the game, the higher your chances of success. So, remember this: making money in investing is important, but protecting your money is essential, because you can't grow what you've already lost. Focus on managing risk, and the returns will follow.
You can stand under my umbrella.